Hey, you thinking about getting started in private money lending? Well, do not dive into that venture without the right legal setup. Listen, private lending can be a lucrative business offering great returns and the opportunity to help other investors or, in my case, developers achieve their goals. But before you jump in, it's crucial that you have the right structure in place to protect your assets. In this video, I'm going to walk you through the key steps to setting up a private money lending business. We'll cover how to choose the right legal structure, the importance of solid contracts, and strategies for managing risk. We're going to talk about whether or not you should set up a corporation or LLC, or maybe you need both. So, what I help you do in this video is build a strong foundation for a successful venture with private money lending. So, let's get started. Okay, so when it comes to private money lending, I'm just going to share with you what I started doing. So when I went out there and I realized I could work with investors, but I chose to work with small developers because I felt that was the safer route than working with investors. And the reason that was is that a lot of times what I found with private money lending is that people were loaning to investors on, say, a flip deal, which is typically how you're going to lend. They were taking second positions. Whereas when I'm working with a small developer, maybe someone's building one or two houses at a shot, I'm coming in the first position. Now, depending on where you want to go with your private money lending, the key is setting up the structure the right way to make sure that you're protected, your investments are protected as well. And so I want to discuss is the structure, and then we'll talk about the paperwork that goes behind making sure that you've dotted the I's and crossed the T's. So if something goes wrong, you're absolutely protected in that event. So number one, how do you create the business? Well, in my case, I looked at it and I said, do I want my income to be passive or am I looking for active income? Okay, so this is really important here because it's going to determine the type of entity we set up. So in a passive income structure, all of the income that I generate, the interest that comes in from the deals, it's just passive and it flows onto my tax return. Now, the problem with passive income is that if I'm looking to contribute to a self-directed IRA or a solo 401k, or I'm looking to get tax deductions and write off certain things, passive income does not lend itself well to that type of activity. So in that case, what you want to do is take your private lending activity and actually make it an active business. And so that's going to change the type of structure we're going to focus on. So in my instance, what I did is I created a Wyoming LLC and I put my cash inside of this Wyoming LLC. Now I'm doing this because I want it to be passive. And so in my Wyoming LLC, it is set up as a disregarded limited liability company, which means it does not have to file a tax return. So let's call this one's Freddie Fast Lending is the name of my LLC. So I set up Freddie Fast Lending and I found this developer that's building some homes. And of course, rather than working with the bank, I said, hey, listen, you can go to the bank and they're charging you 3 points plus they're asking for 10% interest. I'm going to charge you two, and I'm only going to ask for, say, 9% interest on my deal. So they're saving some money there. So then the way I would structure it is I loan money to this individual through my Wyoming limited liability company. Now, I don't live in Wyoming. So even though my Wyoming LLC is the one loaning the money to the developer, I have all the interest payments sent to a local address. So I explained to them, hey, on a monthly basis, when you're paying the interest, pay it to this address right here. So I actually invoice them every month for the interest that is due. Now, I understand there's different ways you can set up these deals. You can have it all ballooned out at once, and when the deal flips, that's totally up to you how you structure it. But this is how I structured it. Now, why did I put that private lending activity into this Wyoming LLC? It's not so much from the standpoint if something goes bad over here. I'm protected on something happening on the property itself. What I'm concerned about is if I were to be sued. That if somebody sued me, I don't want them to get up and be able to take that note. You see, when you loan money to a third party, being an investor or in my case, the developer, you're putting together a promissory note where this person agrees to pay you back principal and interest on that deal. Now, that note that you hold, if you hold it in your own name, that is an asset that a personal creditor could go after and attach. They could take that note from you, like cash. So I want to make sure that those notes are out of my name. I do not have any private notes in my name. And the other reason why I did it this way, and I use an LLC in this structure, is that say something were to happen to me, right? Then that LLC is part of my estate plan. So it passes to my spouse, to our, or if she were to pass away, to our beneficiaries. If it was a private note was in my name, that complicates that entire structure. Now the kids have to step in, so they have to take control of the note. They have to reach out to that investor or to that developer and let them know, hey, start making all payments over here now. My parents have passed away, and they're going to, presumably say, well, how do we know your parents have died? How do we know you're the right person to pay the money over to? So just eliminate that concern altogether. Keep it simple. And so structure it through an LLC so the LLC does not pass away if something were to happen to you. So that's why I did that. Now, I'm keeping everything passive in my structure. If you want to make it active because you want the income coming in, so possibly you said, hey, I want to set up a solo 401k right over here because I'm going to be running this private lending business. I work for the business. This is an LLC, and I'm the owner as well of my business. Then in that case, I'm not going to use Wyoming. I'm going to set the entity up in the state where I reside because what I'm going to do is set myself up on payroll. So this LLC is loaning the money to the investor. And this LLC is typically going to be set up as an S Corp or C Corp for federal tax purposes. Now, on the private lending side, I'm probably going to opt for an S corporation for that business. And so I'm going to then loan them the money, and the investor now pays the company back. I take that money and I set myself up on payroll so I can make contributions to my solo 401k plan. Or maybe it's an IRA that you want to make contributions. So I've turned what was passive, running it through a Wyoming LLC, now into active by running it through an LLC set up in my state. But what's different here, and this is what's key, how I choose to set it up for tax purposes. Now, if you're concerned about anonymity, okay, I get it. When you set up an LLC, let's assume this was Washington State, people are going to know that I have this entity. Another concern that you may have is that if I set it up here in Washington State and I'm the owner and I get sued, they could take my LLC and then I don't have the asset protection that I may be seeking for this type of investment. So if that's your concern, you can always wrap this entity down here into a Wyoming LLC that is disregarded. You could set that up as a disregarded LLC as well. Down here has to be disregarded. So we'd be the owner of the Washington LLC in my examples. What does this do for you? Well, if I was looking for that, I own the Washington or the Wyoming LLC. The Wyoming LLC owns the Washington LLC. If somebody were to sue me, I get all those charging order benefits that come from Wyoming, so they can't get up to my Washington LLC to get after my promissory notes or my cash that I'm just sitting on waiting to lend out. So it protects it. It serves as a blocker. The second thing it does for me, it gives me anonymity. So if somebody's looking at my name, they're not going to see my name associated with this Washington Limited Liability Company because it's owned by the Wyoming LLC and Wyoming doesn't collect any information. That's why in my structure, I'm using Wyoming for my private lending. So over here, if you want to do an active business, then you definitely want to make sure that it's running through an entity that's taxed as an S Corp or a C Corp. Okay, so that gives you the ability to set yourself up on payroll and do the expenses and things like that that you can take out of there. And hey, if you want to learn more about various expenses that you can run through your business, I have a great resource for you. It's our 1-day tax and asset protection workshop. In the show notes, there's a link. It's a free event. I'd encourage you to attend it because part of that event, for half the event, we're going to talk about different ways in which you can pull money out of a business, money that comes out to you completely tax-free, but is a deduction to your business. These are strategies that we've been implementing for our clients for over 20 years to put tons of money back in their pocket. Be a great idea for you or opportunity for you now to learn more about how our successful clients are removing money out of their businesses completely tax-free. I encourage you to join me on that event. All right, so this asset protection here and tax strategy planning would be for those of you that are looking to reduce your taxes. Now, the other aspect about putting together a private lending business are in the documents itself. So just the other day, I had a client, a very successful real estate investor client that also does private lending on the side, send me his document. So he sent me a mortgage agreement that he has. He sent me a promissory note, and he sent me a personal guarantee that he asked the borrowers to sign. Now, I looked at these documents and I could tell right away that they were probably taken somewhere from the internet or somebody gave them to them just by the way they were put together. And what do I mean by that? So he has a personal guarantee that supposedly referenced the promissory note. But in his personal guarantee, it doesn't reference the promissory note per se, it references a loan agreement. Well, yes, you could say, well, that promissory note is a loan agreement, but the identified term is a promissory note. So if you're going to reference a particular document in a personal guarantee, then you want to make sure that you're very specific about the document you're referencing. So in this case, his personal guarantee referenced a loan agreement and it didn't even state the date of the loan agreement. So it calls into question whether or not what document I actually gave a personal guarantee on. Now, this is important. So when you're setting up when you're going to get into private lending, you're setting up your documents. Here's what you need. Okay, number one, you need to secure your note against the asset. So this, you have two options. As I said, he used a mortgage. I use a deed of trust. Okay, so this ensures that whatever I'm loaning against, whatever asset I'm loaning against, it's going to be secured against that property. So it's going to show up on title that, hey, there's a lender out there. Now, I will only loan in first positions. I do not do second deeds of trust or second mortgages on properties because there's too much risk, in my opinion, for that. So I like to do a first position note on these deals. Now, so you need one of those. Now, typically when it comes to putting these together, you can go to an attorney to put it together. Do not try to do this on your own, possibly even the title company. I actually have the title company put mine together. I review them, but I figure, hey, they're the ones going to record it. I'll let them do it. And if they screw it up, well, then it's on them. So a deed of trust or a mortgage is important. You got to have that to secure your interest. Now, who is this going to point back to? I mean, who's going to be the secured party here? It's going to be your LLC that's loaning the money, as I just showed you, the blue box or the orange box. Now, the second thing you're going to need to back up this encumbrance you're putting on the asset is going to be a promissory note. Now, depending on the type of loan that you're doing. So I'm working with a developer. So we have a promissory note to buy the property, and then that is going to be a separate loan agreement for the actual construction because it's a ground up deal that we're doing here where we're building a house. So then I have a separate loan agreement that I put in place with that borrower for the construction of the home. So you may want to use a loan agreement as well, depending on what you're financing. Now, what's the difference between the two? So the promissory note says, hey, I'm going to loan you this amount of money to buy this property, and I'm securing it against the property, and you're going to pay me back, interest. And of course, when the note hit maybe in 2 years, then it comes due and payable, the whole note. A loan agreement is structured so that when the builder, in my case, or the investor needs money, you're not going to loan them all the money up front. What you're going to do is you're going to loan them chunks of money at a time. So they're going to come to you and say, hey, I need another chunk of money. All this work's been done. Here's proof of it. Boom. Now can I get the funds to pay off my contractors? Or maybe you got to front them the money to begin with. However you structure it, that's completely up to you. But that is what a loan agreement is going to reference, different than a promissory note. So you want to make sure that you have the correct agreement in place that matches up to the type of deal that you're doing. And I would highly recommend that you have a professional draft this for you. Once you got your first one done, then you can keep continuing to reuse it as long as the terms don't change. But you don't want to mess up here because there's a lot of important provisions that can go into these documents that are going to protect you. For example, the third thing you look at is that personal guarantee that you're going to want from the borrower. Now, here's the thing. So the individual that sent in these documents, he's a platinum client here at Anderson. So of course he asked me to review them. I've been working with him for years and no charge for him to have me take a look at these. I really wish he would have sent them to me earlier and I could have taken a look at them because the concern that I have is that in these instances, many times when you're borrowing money or you're lending money, the borrower themselves is an entity, right? So when you're loaning money to an entity, a personal guarantee is fine, right? You're going to get that from the owners of the entity, but why not also tie up the entity? So if you're going to tie up the entity, make sure the entity is given a guarantee as well on that deal. And so that would be a corporate resolution that the entity itself also agrees to guarantee that note. Now, you might be saying, well, Clint, if the entity's borrowing the money, it's on the note. I know. But here's the thing. In the court of law, what someone could argue is, hey, that corporation did not have the authority from its directors or shareholders to enter into that agreement. Therefore, it's not liable. So the way you protect yourself is you have a resolution, LLC or corporate resolution, stating and signed by all the members and the people that run it, that the corporation or LLC is authorized to take this action to borrow the money and they unconditionally guarantee to repay. So I actually require both in my loan agreements. Of course, I'm going to have this resolution, plus I'm going to have a personal guarantee. Now you can wrap this also into the promissory note. They don't have to be separate. My client that I was referring to has a separate personal guarantee. Actually, that guarantee was well drafted, but I like things a little simpler. So I just wrap mine straight up into the promissory note with the personal guarantees. And if you do that, you have to make sure that when the borrower is signing, okay, they're signing once on behalf of the entity. So in this case, it would be, Carter Coons as president of Freddie's Build Homes Quick LLC, but also Carter Coons as a individual. So that means that he's signing on behalf of the entity and pledging the entity, and he's pledging himself individually because in the actual agreement itself, it states that he is going to be personally guaranteeing this note. So you can do that in the promissory note, but you have to make sure that they sign in both capacities. That is, the borrower on behalf of the entity and as an individual. So you want to make sure you get those documents set up, and then, there you go. You're going to start making money from your private lending business. And so the key here is with private lending, choosing the right entity structure, choosing the right tax status for it. And then those documents that I discussed, those are what will protect you in the event something goes wrong on that property. And of course, managing the deal is also always going to be important to make sure that what is laid out by the borrower is actually taking place on the property. Because I've seen other individuals getting involved in situations where they're still sending out money and they're not verifying that the work is being done. And then they find out they've loaned $200,000 on a piece of property, and that money went to another deal to finish off another deal for that borrower, and it never got put into that property. And then our clients ended up losing money on it. Things like this can happen. Hey guys, if you liked the video, be sure to smash the like button. And if you're not yet a subscriber, well, this is your opportunity to subscribe right now. Go down there, subscribe to the channel, so every time I release new content, you'll be updated of my new videos as they get released. Take care.